You know how getting a mortgage today is just a mountain of paperwork, right? But what if it wasn't? What if you could get one kind of on the honor system? It sounds totally wild, I know, but it was a very real thing, and it had huge consequences for, well, all of us. Let's dive in.
No, I'm serious. Just picture it. You walk into a bank, you tell them how much you make, no proof needed, and you walk out with the keys to a new house. It sounds crazy today, right? But this was a real type of loan that poured gasoline on the housing market. It was called an Alt-A loan, and that's exactly what we're going to break down.
Okay, so before we get into the nitty-gritty of that honor system stuff, we have to understand what a normal mortgage looks like today. And that means we need to talk about the gold standard, something called the qualified mortgage, or QM for short.
And the whole game with a QM loan comes down to two words: ability to repay. This is everything in modern lending. It's a rule that was born from the ashes of the 2008 financial crisis. Now, lenders are legally on the hook to prove you can make your payments. They can't just cross their fingers and take your word for it anymore.
So think of these as the safety rules of the mortgage world. A qualified mortgage puts up all these guardrails to protect you, the borrower. A bunch of risky features are just not allowed. For example, interest-only periods? Gone. That's where you're just paying interest and your loan balance never goes down. Or even crazier, negative amortization where your loan balance actually grows every single month? Nope, banned. All these rules were put in place specifically to stop the kind of wild stuff we're about to get into.
But, not every loan fits perfectly into that safe little QM box. So what happens then? Well, there's a whole other world of loans that play by a different set of rules.
And these are called non-conforming loans. Now, here's why that name matters. A conforming loan meets the rules of government-backed giants like Fannie Mae and Freddie Mac, so they can be easily bought and sold. But a non-conforming loan? They can't. That means the bank that made the loan is either stuck with it or has to find a private buyer. And believe me, that changes the whole risk game.
Yeah, non-conforming is a big bucket. It's got jumbo loans for those multi-million-dollar mansions. It's got subprime loans for folks with really tough credit. And sitting right there in between those two extremes, you find our star for today, the Alt-A mortgage.
All right, so this brings us to the big question. If it's not prime, for the safest borrowers, but it's also not subprime for the riskiest ones, then what in the world is it?
Honestly, this phrase just nails it. Alt-A, which stands for Alternative A, was meant to be that middle ground. It was built for a very specific type of borrower who didn't quite fit the traditional mold.
And this is so important to get. The alternative part had nothing to do with bad credit. Nope. In fact, a lot of these borrowers had fantastic credit scores. The big difference was the paperwork. These loans were perfect for people who had good income, but it wasn't a simple W-2 from a 9-to-5 job. Think about it. Small business owners, freelancers, salespeople on commission. Their income can be all over the place, and proving it with a pay stub is tough.
And that one little detail, the paperwork, is the whole story. It's why these loans blew up in popularity and also why they became so incredibly dangerous. It really was a showdown between proof and a promise.
This chart lays it out perfectly. A standard loan today is like a full-on forensic investigation. Lenders want your tax returns, your pay stubs, your bank statements. They verify everything. An Alt-A loan, on the other hand, it was more like saying, trust me. The amount of proof they required was tiny, and sometimes there was literally none at all.
And it gets even more interesting, because Alt-A wasn't just one thing. It was a whole spectrum of low-doc loans, kind of like different flavors, each one a little riskier than the last.
Let's start with the SISA loan. That stands for Stated Income, Stated Assets. And it's exactly what it sounds like. You, the borrower, just stated your income. You stated your assets. And the lender, they didn't verify either one. This was it. This was the pure 100% honor system mortgage.
Okay, take one tiny step up the safety ladder and you get the SIVA loan. Stated Income, Verified Assets. So here, your income was still taken on your word, but the lender would at least peek at your bank account to make sure you actually have the assets you said you did. A little bit of a sanity check, And then, things start to get really weird. Meet the NEVA loan. No income, verified assets. With this one, you didn't even have to say what your income was. The lender just confirmed you had a job and some assets in the bank and basically said, yep, that's good enough for us.
And that brings us to the final boss of risky loans, the no-doc loan. This was the absolute peak of the mountain. No documentation for income.
no documentation for assets. The bank basically looked at just two things, your credit score and an appraisal on the house. If those looked okay, you got the money. That's it.
So, you can probably see where this is all heading, right? This entire system was like a ticking time bomb. And that's why this story is so important. There is a straight, unbroken line from these no-doc promises to the enormous financial risk that built up, and then to the regulatory crackdown that came after.
Think about it. If you don't actually check someone's income, you're lending money completely blind. You have no real idea if they can actually afford the payments month after month. So what happens if their business has a slow quarter? Boom, the risk of default goes through the roof. And when you're not just making one of these loans, but millions of them, you're creating a level of risk that can bring down the whole financial system.
And in 2008, that risk became a catastrophic reality. The mortgage crisis hit, and it laid bare just how toxic these loans were. The government had to step in, and they stepped in hard. First, in 2008, you get new laws to regulate the loan officers themselves. But the big one came in 2010 with the Dodd-Frank Act. That's what gave us the Consumer Financial Protection Bureau, and you guessed it, that ability to repay rule that changed everything. So, what's the bottom line? Well, the honor system mortgage is basically extinct. That ability to repay rule we started with, it makes it pretty much impossible for a mainstream lender to offer a CISA or a no-doc loan like they used to. Today, the law demands proof, not just a promise.
And that leaves us with one last, really big question. The pendulum swung from one extreme, the Wild West of state your income, all the way to the other, today's super strict verification. These new rules were definitely meant to keep the system safe, but did we also make it too hard for those legitimate self-employed people, the ones Alta loans were originally for, to get a fair shot at a mortgage? It's a really tough balancing act, and one we're still dealing with. Thanks so much for tuning in.